Morning. My name is Robert Misey, and welcome to my continuing series on the international provisions of the Tax Act of 2017. Today, we're going to talk about year-end planning to reduce global intangible low-taxed income, known as GILTI, as charged. Brief introduction. We've talked at length about GILTI in the past. If you're a U.S. shareholder of a CFC, you have to report and pay tax on income of that CFC that's greater than 10% of depreciable assets. So, brief example here, U.S. individual owns an S that owns a CFC. The CFC has $2 million of income and $10 million depreciable assets. 10% of those depreciable assets is $1 million. $2 million minus $1 million is $1 million. At a 37% top ordinary rate, that's $370,000. That is a hefty hit for U.S. individuals. Now, if the CFC is in a treaty country, we can make something called a 962 election, an obscure part of the code that came about in Subpart F in 1962, which we rarely used. We can make this election, so we don't have to do it this week, but we can make the election on a timely filed return for 2019. That creates a fictitious C corporation. As you tell, I got my dotted lines and everything. It's a fictitious C corporation. So that it's a C corporation that is treated as earning the GILTI. Because we have this legal fiction of a C corporation treated as earning the GILTI, we get the 50% GILTI deduction and we get the limited deemed paid foreign tax credit. The previous slide, we didn't get either of those, even though they paid $280,000 of foreign income taxes. The upshot is the corporate tax on that fictitious C corporation is $35,500. That's a lot less than $370,000. Now, what if U.S. individual wants the cash in his or her hot little hands? They're going to have to take a distribution of $964,500 because it's coming from a treaty country. That's a qualified dividend. Taxed at 23.8% for $230,000. Now, 230 plus 35.5 is 265.5. That's not cheap, but it's over $100,000 less than $370,000. This works if we're coming from a treaty country and we want the cash in the United States because we can get the qualified dividend rate. What happens if we're operating a CFC in a non-treaty country? In that situation, we aren't going to get a qualified dividend from this notional C corporation. Instead, we're getting a dividend from a CFC. So in that situation, I recommend, if it's a non-treaty country, contributing the CFC to a C corp. And this play is urgent. You have to do this before year end. Last year, that week between Christmas and New Year's, I probably formed about 20 different C corporations to hold CFCs. The tax impact are the same. We contribute the CFC from a haven, basically a haven, a non-treaty country, to a C corporation. We're going to get the same rate of tax as if we make a 962 election. So if you have a CFC in a non-treaty country, you have to act now. What happens if you're afraid to do that because you're afraid of losing previously taxed income due to a 965 inclusion at the end of 2017? The way to do that is distribute a note. Take a dividend that's tax-free to the U.S. individual as previously taxed income, and then the payments of the note are just a return on the debt. They would not result in income. Well, thank you for joining me on this installment of my continuing series. I hope and look forward to seeing you next time.